An insurance renewal lands beside a hospital referral on a kitchen table. One asks for more money. The other offers no treatment date. In 2025, health insurance payouts per member rose 75%. More New Zealanders were also ending their private cover. Here is what those policies mainly buy. They buy speed and choice for care that can safely wait. They do not buy a second emergency health system. That distinction explains both the value and the limits of private cover. It also explains why rising premiums create a public problem. Begin with 3 people entering New Zealand healthcare through 3 different doors. The first person wakes with crushing chest pain. That person needs 111 or an emergency department. Urgent care is based on clinical need. A private insurance card does not move someone ahead in emergency triage. The second person falls from a ladder and breaks an arm. New Zealand handles that injury through its no-fault accident scheme. The Accident Compensation Corporation covers accidental injuries across the country. It covers residents and visitors, regardless of who caused the accident. Some treatment charges can still remain. However, private health insurance is not the main door for that broken arm. Now meet the third person. Her knee hurts every morning. She can walk, but stairs have become slow and painful. The problem matters greatly, but it is not an emergency. This is planned care. Planned care includes treatment that does not need to happen immediately. It can include specialist visits, scans, and operations. New Zealand used to call much of this elective care. Elective does not mean optional or unimportant. It means treatment can be scheduled without immediate danger. That one word creates the space where private insurance becomes valuable. The public journey usually begins with a family doctor. The doctor sends a referral when specialist help may be needed. A specialist service reviews the referral. It then considers the person's need and likely benefit from treatment. This is not simply a queue ordered by arrival time. Clinical priority matters. 2 people with similar pain may receive different decisions. Their conditions, risks, and possible benefits may differ. A person accepted for treatment may receive it within 4 months. Another person may be reassessed after 6 months. Someone else may return to their family doctor for continuing care. That final result can feel like rejection. It often means public treatment cannot be offered at that priority level. The door still exists. However, the threshold can sit higher than the person's present need. At the end of 2024, the numbers showed that pressure, 59.2% received elective treatment within 4 months. 34,615 people waited longer. The national goal is much higher. By 2030, the target is 95% within 4 months. The gap between those figures is where waiting becomes part of daily life. Now place private insurance beside that public route. A policy is a contract covering named services under specific conditions. Hospital plans commonly focus on major treatment, specialist care, and tests. Broader plans may also help with everyday services. Every policy has limits, exclusions, and approval rules. Many policies also have an excess, that is the amount the customer pays before insurance contributes. Private cover can open a different route for planned treatment. The patient may see a private specialist. They may choose among available providers and possible dates. Treatment can happen sooner when private capacity exists. The policy therefore sells something less dramatic than rescue. It sells a more predictable calendar. For a painful knee, that calendar can transform a year. It may mean returning to work sooner. It can make childcare and family plans easier. It can prevent months of worsening pain. That value is real. However, it is not unlimited. The policy only pays for what its wording covers. Cosmetic treatment is commonly excluded. Some medicines, procedures, or provider charges may sit outside the limits. Previous health problems can also be excluded as pre-existing conditions. This becomes important when somebody changes or cancels a policy. A condition developed during long-held cover may be protected under that policy. The same condition may be excluded by a new insurer later. Cheaper cover can therefore carry an invisible loss. The loss protection may only appear when a claim is made. That is why a premium cannot be judged like a grocery bill. Stopping a grocery purchase changes tomorrow's cupboard. Stopping health cover can change which past conditions remain insurable. The industry numbers make this tension visible. In the year ending September 2025, there were 1.35 million covers. Insurers paid $2.545 billion in health claims. Claims per member then rose sharply during 2025. Treatment became more expensive, and insured people used more care. An insurance pool must collect enough money to meet those claims. A premium is not a personal savings account. This year's payments help fund this year's treatment across the group. When claims rise, insurers face pressure to lift premiums or change benefits. Households then face their own pressure. The healthiest members may feel they receive the least value. Some reduce cover, some increase their excess, others cancel completely. That can make the remaining group more expensive to insure. People expecting treatment are more likely to keep paying. The pool can gradually contain more claims and fewer low-cost members. This is the difficult circle inside voluntary health insurance. Higher claims push prices upward. Higher prices encourage some lower-risk members to leave. Their departure can place more pressure on future prices. The public and private systems also affect each other. Imagine them as two doors opening onto one clinical workforce. Private hospitals and public hospitals use many of the same kinds of professionals. Surgeons, nurses, anaesthetists, and imaging staff do not appear from separate worlds. Private treatment can free a place on a public waiting list. Publicly funded operations are sometimes performed inside private facilities. That cooperation can increase the total amount of planned care. However, shifting workers away from public hospitals can reduce public capacity. The hardest public cases cannot always follow them. Private providers often handle shorter and less complex operations. Public hospitals must also manage emergencies and intensive care. They train the next generation of specialists too, so private insurance is not a separate health system beside the public one. It is another payment route through part of the same national workforce that produces a surprising balance. Private cover can shorten one person's wait. It can also reduce demand on the public route. Yet the public system remains the foundation beneath both routes. It handles emergencies, complex care, and people without private cover. This is why widespread cancellations matter beyond individual households. Some cancelled policies will become extra demand for public planned care. The change may not appear immediately. It appears later, when a scan, specialist, or operation becomes necessary. Return to the two papers on the kitchen table. The renewal price is clear. The value on the other side is harder to see. It is not better emergency triage. It is not automatic cover for every treatment. It is time, choice, and predictability within planned care. Before cancelling, ask the insurer 3 questions in writing. Which benefits could be reduced while keeping important cover? How would a higher excess change the premium? Which existing protections might be impossible to restore later? Those answers make the real trade visible. Share them with someone staring at a renewal bill. The largest cost may not be the premium they stop paying. It may be the cover they cannot buy back.